Good day, traders. Stacey Burke from Stacey Burke Trading. Last few days we've talked about just setting up your charts with some basic timing indicators in terms of the Asian sessions and looking at three things mainly that tomorrow are going to be the same, the day after are going to be the same, and the day after that and the day after that. And that means we're going to have some consistency every single day in our approach to the market with something that's reproducible, that repeats itself, that you and I can agree on. They're pretty hard to argue because they're fact. And what's important about that is that these also have a huge influence on how the institutions trade, and also how we can use this to protect ourselves from getting into trapped into the market in the wrong direction, or getting trapped into false moves, into stop hunts, and ultimately 90% or more, 99% or more of retail traders lose money. The smart money uses tactics to manipulate us, to trick us out of profitable positions before they move, to trap us into losing positions before they make a fast shift to trap us and put us underwater. But today we're going to review the week and again just talk about three simple things that are going to show up tomorrow on Monday, and they're going to be there on Tuesday, Wednesday, Thursday, and Friday. Now, the main reason that I follow the 6 major British pound cross pairs is that they move consistently every day in very similar patterns week in and week out. They tend to have 50 pip movements at least, if not more. We're going to talk about the average daily range in a couple of videos and just go over that in detail in terms of how you can use that in your analysis. But the main thing that we're going to talk about, the three main things that we're going to talk about, and we're going to review them for the week, and we're going to use those this week, tomorrow, or the day after, and we're going to talk about how they repeat every single day and why we can use that to our advantage to profit from the market. The first thing is the high and the low of the day. Now, Monday, obviously, as Monday begins to trade, the high of the day and the low of the day are actually the high and the low of the week. And what you'll often see is that Monday will have a relationship to either Thursday or Friday, or whatever the high or low of the previous week was. Typically, it can be a Friday or a Thursday. And that can often be a point where the market will turn or trap traders who believe that that current move is going to continue, and they'll reverse that, and we'll have some kind of 2 or 3 day pattern that we'll set up before it reverses again or continues again. And so it's important that we work from the extremes. That is where our risk can be controlled and held to ideally its smallest point. And one of the things that people need to understand is that that does not mean that we are blindly buying lows and selling highs. There are situations when we're going to have trend trades, and this is why it's important to look at aspect number 2, the equity market opening times, which are 3 a.m. New York and 9:30 a.m. New York for London and New York trading sessions. And the reason why this is important is that the market will often generate moves prior to the equity opens that will either possibly be the trap or the trade. And that's one question that you want to be asking yourself all the time. Am I in the trap or am I in the trade? And the third critical factor is to be focused on round numbers, 50s and zeros. Quarter levels outside of the extremes, when you're at a weak high or low, are often the false break extension. A false break or a false move on a longer time frame will usually be somewhere in the area of 25 pips, and it will very rarely do round numbers, 50s and zeros, end the week as the high or the low. Now, that does happen, but often the case will be that will be the 25 pip extension in itself of the previous daily high or low of the week that the market has just broken out of. So, but just to keep things simple, the primary area you want to focus on are 50s and zeros. These are definitely major institutional trading levels. We want to focus on the equity opening times. Not to say that there aren't moves that start earlier, But if you are in a move going into a market opening time and you're within a 25 pip range, chances are you could be either already in a strong move, or if it's in a consolidation, that you could be trapped into the move that's going to be caught in the stop hunt. And then again, high and low of the day. This is the area that we can control our risk the greatest. And we also have an asymmetrical profit target. The other thing that I really like about the pound crosses is that with the 6 of them, inevitably, without a doubt, there's one usually textbook trade setup every single day in each session on at least one of the pairs. But today, let's just review what happens based on these 3 factors. We can see the pink little box. I've included that today just to give you a reference point color-wise that is the London Open. The 10 o'clock candle is the London Open. So on Monday, we're just looking at the pound yen cross. We see the market generate a trade right at the Asia close, heading into the Asia close Europe Open, where they've dragged traders off the previous day's low. And actually, today we won't include that, but they brought traders up long, almost 75 pips from the low, and then rolled it over into the close and had an aggressive move down. So we call this a creeping trend up and then an aggressive move down. This is typical of a stop hunt pattern where it will move fast and quickly. But what they've done in simple terms, if you consider this a 50 pip or 50 plus pip box between 0 and 50 basically, they've went to the bottom of the box at the London Open. And then from the London Open off the double zeros, they've aggressively moved back. So people who have shorted the market up here, if they haven't taken profit or they've lifted their stop or they've had a 25 pips is the typical extension minimum on the person who's been in a profitable trade. And that's usually enough of a move that it will bend the arm of most retail traders and some other large traders if their positions are big enough. So at the London Open, we're at the low of the day, the low of the week, and on a smaller time frame, on the 15-minute, whatever you want, this was an opportunity for traders to enter the market. The London market opened up at the bottom of the day. Move 50 pips. We'll talk about taking profits in a later video, but 50 pips is typical unless you're at the low or high of the week and you're able to capture the extreme of the move. Not to say that there isn't an opportunity to take the money and then get back in, but generally speaking, 50 pips is the first profit target outside of the pound Swiss, the pound Canadian, and the pound, where sometimes I will recommend 40 pips depending on the structure of the market. But point today, high and low of the day, equity marketing opening times, round numbers, 50s and zeros. That's the main thing that we're looking at. Heading into the U.S. session, the market was in a clear directional move long. New York opened inside of the green box is the hour prior to the New York Open. It opened up inside of the box, meaning just want you to start thinking about traders that have stops outside. If the market opens up inside, the trend continued through, stopped out the traders who entered in early and continued its move up. Next day, the market breaks out to the bottom of the 25 pip box down to the 25 pip level, 25 pip increment below the 50 to what we call, this is a hammer setup, 1 bar breakout, a strong breakout of the box in one candle, and then consolidation. This is a stop hunt candle. The hammer prints at the low of the day, but traders who waited for confirmation at the 50, even though they're chasing this trade, still had a 50 pip move to the high. They come back. The New York hour before the New York session, the market moves down again aggressively just into the open of New York to the low of the day once again. Traders possibly may have entered in somewhere off of this area depending on what their time frame was or reason, but I'm not saying there was a trade there. But again, at the equities open, they stop hunted the low of the day, so the trader here that didn't take any profit was stopped out aggressively heading into the New York Open and then the consolidation into the close. The next day, the market trades sideways in a 25 pip box into the London Open. London is still inside of the Asian range, and also we'll talk about peak formation highs and lows of the week. And something I want you to consider now is that when we head into Wednesday's range, we're actually inside of the high and the low of the week. So we're inside of the box. So if you think of this as a high and a low, we want to be selling somewhere up high in this range or buying somewhere down low in this range. This pattern itself is something that we'll refer to later as a straightaway setup, where the market goes sideways underneath a peak formation. The London candle 1, 2, 3 to the high doesn't go anywhere and reverses. Traders would have shorted this market somewhere around 75 or on this candle and held on to it, heading back at least to the previous day's low and beyond. Again, we talked about 25 pips into the traders that usually have the right direction initially. So the trader who was long off the previous session's low, start thinking that that market moved 50 pips, but it didn't go anywhere, and eventually it rolled over to retest the low and go sideways into Thursday's range. Asia consolidation. So the next thing to be considering each and every day is, as Asia's consolidating, where are my major number levels? So on this particular day, again, the previous day we were between 50 and 75. This particular day we were between double zeros and 25. London opened up inside of that range, so we don't do anything. But traders who waited for it to come outside of the high and the low were looking possibly as a double zero entry off the low. The market came back up to stop hunt traders who had shorted the high of the day, before again it aggressively came back to the low of the stop hunt where the trend was continuing down. New York stop hunts the low of the day. This again is an example, the one big bull candle of a stop hunt candle. They've stop hunted back into the box and then gave a little inside bar at double zeros to resume the move back down. Again, the point I'm making here is not where I would have bought and sold, but referencing the three things: the high and the low of the day, the equity opening times, okay, and then round numbers, the significance of round numbers. Just to reinforce something, when the market opens up inside of a range, traders who get inside of this box often may be trapped when the market does come back in on a stop hunt, which inevitably it will do when it's inside of a high and a low. Sorry, that was Friday. So into Monday, again, we look at our numbers. We're looking at 50 as a possible major level. Asia takes out the previous Friday's low, pulls back above 50, so now we're above 50, works its way down, and breaks out and does almost a 25 pip stop on the traders that are long from earlier in the session, comes back in that London hour to close back inside of the 50 pip box before moving back up to double zeros. When a trade situation like this develops, you redraw your high and your low. So we have a high and a low of the day, but where the market has turned now, we're going to redraw that. When the market opens up, it breaks through the low of the day, consolidates, and then comes back inside, and then moves up aggressively through the high of the day, 25 pips past the high. So you can start doing the math that if you're buying somewhere down low, and the market is indeed going to stop hunt the high of the day, there's a possibility of it making a 25 pip move past the person who shorted the market early, but also there's a profitable trade from the Friday night US session that still hasn't been stopped out at break even up in this range. We'll just color that in so traders can see that. And again, so somebody who's shorted it on Friday night in the US session, they've gone to break even, or they haven't taken any money off the table, the market goes back up on Monday to stop them out. So anybody who tells you that stop hunting is not real is lying to you. So again, we go into Tuesday's trade. Immediately, the Asian range stop hunts anybody who's short up here at double zeros. They work their way into the high of the day. So again, looking at our numbers, double zero is our main major level. We're underneath of that, so we would include the 50 as a possible target for a stop hunt. The market consolidates at 75 before again popping back inside. Okay, just to rehash, three main things: high and low of the day. Tomorrow, all of us can agree there's the high and the low. So typically what I'll do, actually I'll leave the screen up here. High and low of the day and the week. We know the equity market opening times are going to be the same, 3 a.m. 9:30 a.m. And we also can focus on round numbers. Just to also mention, the average stop hunt is going to be 25 to 50 pips. And sometimes that stop hunt may occur inside the box. So the stop hunt may be 25 pips up between numbers. And you have to start thinking about where profitable trades are from the previous sessions, because those are going to be where stop hunts occur in Asia in a lot of cases. So if I just tighten these screens up, I'm just going to show you how easy things can be in terms of just maybe identifying maybe the best pairs that are setting up as Asia prints. So I typically get up, I do my morning routine. I don't, if it's during the week, I'll review maybe the previous, the U.S. session trades to see how things played out. If I didn't stay up, because sometimes I'm just tired, or if I have been able to get 50 pips in London, I'll call it a day. If it's a really wide-ranging day, whatever, but I'll go back and review to see how all the pairs moved. And so you can see that when you have your screens tightened up, as Asia's setting up, if you have your blue boxes there, which obviously during the session they're just printing, so none of that other price action is there, but you can just look right away and say which pairs are at your major levels. Now I'm going to say I am a bit biased. I do tend to look at the pound Aussie and the pound New Zealand a bit more closely to see how the Asian range is trading, because it tends to have the largest movement, and people say, oh, it's too volatile or the spreads are too big. Well, it'll move 50, 75, 150, sometimes 200 pips in a day. So depending on where we're at in relation to the high and the low of the week, and how that pattern is setting up, I will definitely be looking at what my numbers are for each of these pairs. And I'll say that the pound Swiss, and pound Canadian are usually not traded by me that frequently, only because I'll take one of the other pairs more likely if the setup is there. And again, if it's not there, I won't trade it. So sometimes it just doesn't make sense. And I have a premise that if I'm not sure, my odds are less than 50%. And if I'm inside of a high and the low of a range, my odds are 50% of being right. And I don't tend to do too well, even at 50% on a lot of those trades, which is why my best trades, as you can see, when you look at your best trade setups, and we'll talk about screenshotting those, because you're going to see them over and over and over again, and building a little bit of a pattern recognition playbook, and why it's important to focus on those, and why it's important to focus on some things that are reproducible and consistent, that are definitely areas for institutional trades, for tight risk, and for a 4 or 5, maybe 10 to 1 return on your trade size. So high and low of the day, high and low of the week, round numbers, equity opens. Those are three things that cannot be argued by any of us. They're going to happen at the same time tomorrow. We're going to have a high and a low, and we're going to be at numbers on some of these pairs. Round numbers, 50s and zeros, they're critical. So hopefully you got some value from today's video, traders. High and low of the day, high and low of the week. Equity opening times, 3 a.m. New York, 9:30 a.m. New York, Eastern Standard Time. And 50s and zeros are critical for identifying high possibility great trade setups. Stay disciplined, traders. Stay focused. We're going to review tomorrow's market as it's setting up, and we'll look at which pairs may be around those numbers and how they're setting up. If there's any gaps on the open, obviously we could be in for another wide-ranging week. So let's get ready and look for 1 or 2 great setups next week. Stay disciplined, stay focused, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined and may the markets go with you.